speaking of systemic, let's end this. Well, I could talk to you for hours, by the way. This is just fascinating. But let's wrap this up today with kind of where you conclude this wonderful paper. Richard Fisher and I met years ago when I was still inside the Fed. We had lunch. There were riots in the streets of Athens at the time, and I said, Richard, what do you make of this? You know, what can we draw from this? And I've been writing about pensions for 20 years, and he said, Danielle, I fear that we'll have those riots in our streets one day. That the public pensioners and the people who are paying for the public pensioners, and you know, if you're Joe Q with an IRA or a 401k and you lose most of the value of your equity holdings, and you're told that your property taxes or your income tax, state income taxes are going to have to go up to top off the pension that's just lost as much. Yeah. You talk about these things in public forums, and just individuals go at each other. Yeah. Talk about the societal implications of where we are today and what you see potentially happening, because you use the word systemic.
So the way that the average institutional entitlement portfolio is structured today, and this is not an opinion, I'm looking back across history, there is a recency bias. This is constructed for the last 40 years of unprecedented asset price growth. But if you look beyond that 40 years and look at how that portfolio will perform, at a best case, you're looking at kind of a 5% type of return. In a worst case, given where debt levels are and where leverage is, you're looking at something much, much worse. So if we just assume the best case, it makes 5% or 4% over the next 20 years, these entitlement programs.
Which is not enough.
Not enough, because they're targeting 7.25%. That will cause an expansion of the unfunded liabilities in just the state systems alone to about $3 trillion. If we end up getting a lost decade, that could go as high as $10 trillion. You know, that $3 trillion number, that is the cost of 4 bank bailouts. It is the entire tax revenues of the US government over the next year. And that is kind of your base case. These entitlement programs, which right now, based on the 7.25% assumption, will go from 70% funded to under 50% funded. And a third of them will be under 30% funded. And this is not including corporate programs and other personal retirement programs. This issue of asset allocation is a issue of systemic risk. It is a issue of social stability. Because we will be at a point where these entitlement programs will go belly up and face insolvency unless we can think differently about the portfolio construction. I could see a lot of different things happening. I could see a day where the Fed prints money to buy pension obligation bonds.
Chris, if I can tell you something, during the crisis when I was inside the Fed, it was debated.
Wow. That's amazing.
The idea, if you take logic to the end game, the idea of the Fed buying municipal bonds is perfectly feasible.
That's right, and that will be a backdoor bailout of Wall Street if that happens. You could see a radical progressive kind of dynamic where we shift to seize capital and where there's causes massive inflation. There's numerous ways, but the question at the end of the day is the average portfolio is only attenuated to this last 40-year period of growth. It's not about being afraid. It's about being prepared.
Right.
So my parents, during the great financial crisis, they came out ahead because they had allocations to volatility and gold. And that saved them and allowed them to retire on time. I think the institutions, the large institutions and the average investors, if they can find ways to invest large portions in counter-trend assets, not only will they get a better overall return profile and more safe return profile, but this will be a way for these institutions to be able to prosper during a period of secular change,
Right.
rather than suffer. So I think this is a major. It is more than a financial issue; it's a social issue.
Right.
That these defensive assets, they're not for a rainy day. They're for a rainy decade.
Mm-hmm.
The problem that we face is not a problem of financial management or economics. It's a problem. It's a social problem. It's an emotional problem. It takes a lot of social discipline and to think differently. Many of our leaders would rather fail conventionally with the herd
Right.
than succeed unconventionally.
They're not Genghis Khan.
That's right. Yeah, that's absolutely right.
It was great talking to you today. Thank you so much for
Thank
being
you.
with Real Vision.
I had a great time.